The cycle of economic boom and bust explained. The cycle of economic boom and bust is an intrinsic pattern within capitalist economies, characterized by periods of rapid expansion and growth, booms, followed by contractions and recessions, busts. Understanding this cycle is crucial for policymakers, investors, and businesses alike, as it influences decisions ranging from investment strategies to fiscal policies. The boom phase. The boom phase, often termed an economic expansion, is characterized by increased consumer spending, business investments, and employment rates. During this period, the economy grows above its long-term trend as consumer confidence soars, leading to higher spending on goods and services. Businesses respond to increased demand by expanding their operations and hiring more employees, which in turn reduces unemployment rates and increases household incomes. Financial markets typically flourish during a boom, with stock valuations rising as investors confidently pour money into equities and other assets. The positive feedback loop between employment, income, and spending propels the economy forward, but it also sows the seeds of the subsequent bust. As businesses and consumers become over-optimistic, asset bubbles can form, and debt levels can surge to unsustainable levels. The peak of the cycle represents the zenith of economic activity, where growth rates hit their highest before starting to decline. It is often difficult to identify the peak until after it has occurred. However, signs such as soaring inflation rates, tightening credit conditions, and market saturation can serve as indicators. At this stage, the economy operates at full capacity, with labor and resources fully utilized, leading to upward pressures on prices. Policymakers, particularly central banks, may start to implement measures to cool the overheating economy by raising interest rates or enacting tighter fiscal policies. These measures are intended to prevent inflation from spiraling out of control, but also mark the beginning of the end for the boom phase. The bust phase. Following the peak, the economy enters the bust phase, a period marked by declining consumer confidence and reduced spending. Businesses, facing lower demand, may cut back on production and lay off workers, leading to a rise in unemployment. The reduced income and job security further diminish consumer spending, creating a negative feedback loop. Financial markets can suffer significant losses during this phase, as investors rush to liquidate assets amidst falling valuations. The bust phase is exacerbated by the unwinding of debt accumulated during the boom years, as households and businesses struggle to meet financial obligations. Central banks and governments may intervene to mitigate the impacts of the recession by lowering interest rates, providing fiscal stimulus, or implementing measures to support employment. However, these efforts may take time to have an effect, and the economy may continue to contract before stabilizing. The trough. The trough is the cycle's nadir, where economic activity bottoms out before beginning to recover. It represents the period when the economy is weakest, with low consumer spending, high unemployment, and diminished business investments. Identifying the trough, much like the peak, is challenging during the moment, but is characterized retrospectively by a gradual improvement in economic indicators. The recovery. Following the trough, the economy gradually enters a recovery phase, where consumer confidence begins to rebuild, spending increases, and businesses start to rehire and invest. The recovery lays the foundation for the next boom as the cyclical nature of the economy continues. The economic boom and bust cycle is a manifestation of the inherent volatility within capitalist market systems. While this cycle can cause significant economic and social disruptions, understanding its phases can help stakeholders mitigate adverse impacts and prepare for future shifts. Policymakers play a crucial role in managing the cycle through fiscal and monetary measures, aiming to smooth out the peaks and troughs to ensure sustainable long-term economic growth. As history has shown, while the cycle's timing and magnitude may vary, the pattern of boom and bust remains a perennial feature of modern economies. Thanks for watching. If you found this video helpful and want to stay updated with more insightful content, don't forget to hit the subscribe button and ring the bell so you never miss out on our latest videos.